Thank you, ladies and gentlemen. Today we are getting a special edition of our podcast. And in this special edition, we have just come up today to answer questions that some of our listeners, that many of our followers have been posing. So today it's only going to be an answer session. We're going to be answering questions that you have been asking. And let's start today. Again, my name is Charles Njoya. I'm a CPA. I'm a certified tax strategist, and I work and I run this company called CHN Advisors. And at CHN Advisors, all we do is tax and estate strategy. So if you're out there and you are tired of overpaying in taxes, or you think you are not properly structured to meet your overall objective of asset protection, tax mitigation, and wealth building, then this is your moment. Contact us. Book a free consultation. Our website is www.chnadvisors.com. Go to our website and you can book a free consultation with us for an hour, and that hour is going to be free. Then after that, we can decide on how we want to go. Thank you so much. So the first question that is coming from Jamie from Ohio. Jamie says, why is a revocable living trust important? Well, a revocable living trust, we say, is the foundation of your estate from a legal standpoint. It is the foundation. Why is it a foundation? It is that document that allows you to get that privacy that you need. It shields your estate in a way that you cannot, if somebody doesn't know what you own, they are less likely to attack you in a court of law. So basically, it gives you that privacy that you need. A revocable living trust doesn't go through probate. A revocable living trust, basically, it doesn't really get recorded somewhere. A revocable living trust is your private document, and because it's your private document, it gives you privacy. Number two, you are the maker of your own destiny. You're basically telling your next generation that this is what I want my estate to look like. And that document is a very powerful document for people in America. If you're not having a trust, if you don't have a revocable living trust, then you want to get one. It will give you privacy. It will give you that protection from probate. It is flexible. So the flexibility around a revocable living trust is so powerful in the sense that you own the trust. You are your own trustee, and then you can appoint a successor trustee, and then now you can give specific directions on how you want your estate to be managed to infinity. And that is the power of a revocable living trust. Why is it important that it be revocable living trust? Because that trust that is flexible, you can modify it, you can go and fund it, add more things to the trust. And when you die, that trust becomes an irrevocable trust. That is the power of a revocable living trust. For those of us who have special needs children, a revocable living trust is the way to go. Why? Because it helps me to basically direct how this child is going to live even after I'm gone. Because if I don't have specific instruction on who is going to take care of this child, how they can get paid, how they are going to use the money when I'm gone, and they might just misuse the estate and this child will be left to die. So that is why a revocable living trust, this is the most hidden secret of the wealthy. They have kept it away from the masses for a long, long time. But this is a time for you to take charge of your own trajectory. Build your own financial trajectory by starting with a legal document that gives you that privacy. You are able to use it to transfer your estate from one generation to the other in the most tax efficient manner. That is the power of a revocable living trust. So John says, why do you always look at the tax return as the number one item for wealth building? And then Eddie says, why do you always look at the tax return as the number one item for wealth building? That's a great question. Why do you always look at the tax return as the number one item for wealth building? Well, we said earlier that the trust is the foundation of your estate from a legal standpoint. Well, the tax return, which is the 1040, your personal income tax return, is the foundation of your estate from a tax standpoint, is the foundation of your estate from a wealth building standpoint. Why? Because that tax return is that document that allows you to get access to the most important thing that you get in a capitalist country like America. America is a capitalist country. The most important thing you get here is you get access to capital. Capital is the most important, is the most difficult thing for entrepreneurs to be able to build their estate. So basically, if you have capital, you want to be able to structure yourself in the most efficient way to access that capital, because you build wealth by accessing and leveraging other people's money. And how do you access other people's money? By using your 1040. Your tax return, when they tell you, when you want to buy that first asset, that really key asset, what the lender is going to ask you is to bring 2 years of your tax return. There is something special in that tax return that they want to see, and they want to use it to be able to determine if you qualify for accessing that loan. So if you know that one thing, if you know that there is a single thing that will give you access to your dream, why won't you take care of it? So the tax return is the most important document for accessing wealth, and you want to take care of it. You want to make sure that that tax return is prepared by someone who understands the nuances, who understands how to structure a tax return, so that even though you are avoiding taxes on that return, you're using that return to avoid, to pay the least amount in taxes, you are still using that same return to access capital. So basically, we know that the general concept is that most CPAs, most tax preparers, what they do is they try to look for expenses as much as possible to drill down, show that, push down your income to the lowest level so that you pay the least taxes. This is the easiest way, easiest route for someone who doesn't understand anything about preparation of tax return, about the power of a tax return, who doesn't understand anything about strategy. There are strategies out there that we use. The one key thing that gives you access to capital is called EBITDA. The EBITDA is earnings before interest, tax, depreciation, and amortization. That is the most important thing that gives you access. It determines how much you can afford in terms of a loan. And to get EBITDA, there are certain things that you can basically leave your EBITDA very high and still avoid taxes to the least, still avoid taxes. So basically, you have to understand this concept and understand that before you can give the best value to your tax return, you can give the best value to your client. And that is why I see the tax return is the most important thing for access for wealth. Then I did have John who said, should I buy a car to save on taxes? Should I buy a car to save on taxes? What is the answer? The answer is you should buy a car because you need it. You don't buy a car because you want to save on taxes. You buy a car because you need it. And there is one thing about buying a car. Most people think that you just buy a car and it's going to be used to reduce your tax liability. No. The primary thing about anything you want to use as a deduction for your taxes is that thing. Is it ordinary and necessary for the operation? Ordinary, necessary, and is it reason for the operation of your business in the pursuit of income? That is so important. So if you go and buy a car that you're using to go and have your parties and things like that, and you think it's going to affect your taxes, I can just tell you, it doesn't have any bearing on your taxes as long as it's not affecting your business. If you're using it to go to work in a W-2 job, going back and forth, or even going to your business. You have a business and you're driving to your business back and forth. That is called commute. Commute is not tax deductible. Tax deduction is using that vehicle for actual business purposes, using it to generate business, not using it to go to the business place. But when you get to the business, you are using it for distribution. You're using it for going from one client to the other. That is what you call business trips. So now, if you have determined that your car, you need a car for business purpose. Now you want to think about what type of car will be best suited for the type of things I wanted. Most people, they go buy a car just because they know that if I get more than 6,000 pounds, it's gonna be deductible. I'm going to get a higher write-off in year one because I'm going to use section 171.9 and use maximum bonus depreciation. The key is when you're buying anything, you have to look at the cost benefits. You're not getting this car for free. You're buying this car, and you are, even though you took it on a note, you have to foot that note. You have to pay that note. That has to be contributed. That has to be constant. So it's so important that you understand the type of car. I've seen people take cars, and then even though those cars are not doing anything, they wrap it, they go and basically wrap it with the company logo, and they assume that, okay, because I did that, it's become automatically a business purpose. It's not a business purpose until it is actually used for that business. Now, You could tell me that, okay, because I have a car like that, I've wrapped it in this and I'm moving around and I'm making advert. I'm showing there's advert, there's marketing. People are seeing and they're buying because they saw it on that car. That could be a reason. But it has to be a valuable, it has to be a very valid reason. You have to be able to demonstrate that because of what you did, you're getting what you got. It is ordinary and necessary in the pursuit of income for your business. Then that you can write it. And one other thing that people talk all the time is that the other question I just saw there, that is coming from Shirley. Shirley said that she's asking this question whether buying a car in my business name will serve me to avoid taxes. That's a very important question because I see that all the time. People come to me and they believe that just the bare facts that, so many people have come to me and they say, oh, I have my car, I can't write it off because it's not in my business. I didn't buy it using my business name. The IRS has one stipulation. It is around the use of the vehicle. I don't care who owns the vehicle. But if the vehicle is used for business use, then it is deductible for business. It is deductible in the business. If the business is used, it is generating income. It is ordinary, whatever it's used for is ordinary and necessary in the pursuit of income for that business, then it is deductible. I don't care whether it is owned by my father, it is owned by my mother, it's owned by your auntie, owned by whoever, or you had it on lease or whatever you, as long as it is used for the business, you can use it, you can deduct it. Now, there's going to be how does it qualify for certain type of deduction. You start thinking about how much of the vehicle is used for business. Is it used exclusively? Is it used more than 50% for business? Or you think about all these things because they are going to impact how much you can write off in the business, or if you can even take a depreciation of business. So another question on vehicles is coming from Jackson. Jackson says, what is the best way to write off a vehicle? Okay, this brings me to a very important one. What is the best way to write off a vehicle? There is no best way to write off a vehicle. You just have to understand that there's a strategy behind writing off anything. If you are writing off a vehicle, let's say your vehicle is, you have to think about what is the purpose of that vehicle. Let's say I am an Uber driver, and normally I don't use my Uber is not for the XL. I'm using the normal Uber. I'm a normal Uber driver. First of all, if I wanted to buy a car, I won't go there buying an SUV, which is a big car, which is taking a lot of gas. Because at the end of the day, Uber driving is a lot of gas. It's a lot of expense. You write off expenses that you've incurred. So now, instead of thinking about that, I will go for a Prius. A Prius will take me 55 miles per gallon. I'm sorry. It takes me 55 miles per gallon. So 55 miles per gallon versus why would I would rather buy that Prius than buy a truck, which is going at 15 miles per gallon. So when I have these two vehicles, one is 15 miles per gallon. Let's say I'm using that for a particular purpose and I'm using this other Prius for running around and doing my Uber. So what do I write them off? Remember, there are two ways of writing off these expenses. You can either write them off on actual or you can write them off on mileage. Mileage for 2024, each mile, the write-off per mile for business use is $0.67 per mile. So if I were to take actual for a vehicle, for one vehicle, actual for this my same Prius which I just bought, which is 55 miles per gallon, and I decide that I want to go actual, then every gallon will take me $3 because that's the average price of gas pump. It will be 3 miles. I'll just write off $3. But if on the other hand I decided that I was going to go mileage, that same Prius that I just bought, I will multiply that 55 miles times 0.67. What I'm writing off $37. So on one hand, actual just wrote me off $3. And on this other hand, if I take mileage, it is writing off $37. I just multiply that $3 by 12. So what is better? Going mileage or going actual? Definitely go mileage with that vehicle. On the other hand, if I have this car, which is a very huge car, it has a huge trunk, consumes a lot of gas, it's a truck that is going 15 miles, and then the cost of running that truck, the truck is getting older, the repairs and maintenance and everything on that truck is getting, guess what? I am going to go, if I bought a truck that's older and I know it's taking miles, what do? I'm going to go actual, because I know that the cost of running that truck is going to be high. Filling it with gas is going to be high. So I'm going to go actual. So it doesn't really matter what you use. You want to just think about what is the best strategy. What is the best way for me that's going to save me more in taxes? That is very important, because this is where you really know the understanding of the tax preparer, whether the person understands what he's doing. And remember, whatever you chose from year one, you can't change it in year two. If you chose actual, you're going to maintain actual. If you chose mileage, you're going to use mileage going forward until the car is completely done. The other question that's coming from Miriam is that, can a W-2 person avoid taxes? Absolutely yes. A W-2 person can avoid. I mean, I have so many clients who are W-2. If you want to know W-2 clients, there are things out there that you can do and pay zero in taxes and avoid taxes altogether. But you have to come early. You have to register on our program very early so that we can take you through that ride of structuring you. And if there are things that we need to create them before the end of the year, if you come to look for me in December 15th and say, I have this W-2, it might be harder for me because we don't have time to play the game. This is a game. It's a game where you are looking at the tax code and looking at the best ways of giving value to yourself and to your client. So time is of essence. You don't come to me at the end of the year, after year end, and you want me to, you're a W-2, you want me to save you on tax. It becomes complicated. It becomes more difficult. But if you came to me with time, then we can structure you and start doing things. Let me give you an example. I mean, one of the things I tell people who are on W-2, this is one of the biggest strategies where you build wealth. When you are on W-2 and you're a full-time worker, there is no way you can qualify as a real estate professional. So many people have heard this thing that real estate professional is going to help you. There's no way you can qualify as a real estate professional when you are when you are working full-time elsewhere and you're making more money there. To be a real estate professional, you have to make 750 hours. Your primary activity has to be real estate. So you cannot say your primary activity is real estate when you're spending full-time working for someone else. But the other thing is that there's a short-term rental loophole. The short-term rental loophole, you are a material participant in the taking care of your own real estate property. And then the second thing is that you have put in more than 100 hours in that real estate. And then putting in those hours is between you and your spouse. So it took more than 100 hours. And you want to put more hours than every other person. You don't want to buy the property and then put it as a short-term rental and then you get a property manager to put it. When the property manager gets involved, you might not be able to qualify to write that off against your ordinary income, against your W-2 taxes. So that's one of the strategies. There are other ones that we can talk about. Again, the devil is in the detail. You want to know, you want to see the detail and then understand how to structure it and do that well in advance. There's one thing also, when it comes to these short-term rentals, you can do your short-term rental strategy in year one. And after year one, you decide to make it long-term. That is your choice. So you can decide the first thing, you just want to do it for 1 year, as long as it stays in real estate. And then whether you have it long term in year two, that's not a problem from the IRS. So the other question, what is one of the ways a W-2 earner can avoid taxes? I just answered that question a few minutes ago. Okay, the question is, how do I get the money back? I am on W-2. How do I get the money back? Because they already got my money. They already took the money anyway. So if I'm doing strategy, how do I get my money back? So this question is, how do I get my money back? And this is very important. You want to understand how taxes work. So the American system, the American tax code says that you pay your taxes on worldwide income and you pay your taxes as you go. You don't pay your taxes at the end of year. You pay your taxes on your worldwide income. As long as you're a resident, you're determined a resident of the United States, you are going to pay your taxes in the United States on your worldwide income. Now, you file your taxes. I'm sorry. It is about filing your taxes and reporting your worldwide income on your taxes. Now, payment is a whole different ball. The more important thing here is, as you go, you want to make sure you're paying at least equal to last year's tax return or nothing more than $1,000. If you have a tax liability at the end of the year, which is more than $1,000, you're going to be penalized. This is important. You're going to be penalized. You're going to have to pay a penalty for late payment. So basically, when you are paying all these things through the year, you're just making estimated payments, because the actual tax that you're going to pay will be determined when you compile your taxes at the end of the year. Now, if you compile your taxes and you realize that, oh, I had overpaid taxes, you get a refund. If you discover that, oh, I had underpaid my taxes, then you get to pay for the difference. Now, when a strategist comes in, maybe you have been paying taxes for the last 7 months, and all of a sudden you hire me to help you with your tax strategy. And we do strategies for you. Your tax was going to be $100,000. And then you have already paid $80,000 or $70,000 during the year. Let's say it's $70,000. So your tax was supposed to be, you estimated your taxes to be $100,000. You've already paid 70. And then I come in as a strategist, and then we do certain adjustments to your structure. And then you finally discover that you're only paying $20,000, but you've already paid 70. You've already paid $70,000. So the IRS, once you prepare your tax return and it says that your tax bill is $20,000, the IRS gives you back a refund of the $50,000 that you have paid. So the tax preparation that you do at the end of the year is a reconciliation of your tax bill for the entire year. So the other one, what can I do with my 401k to build wealth? That's a great question. What can I do with my 401k to build wealth? Then the other guy says, what do I do to save money with 401k or other retirement? And how can I use my 401k to build wealth? What do I do to save money with my 401k? So basically your 401k, when you are saving money with your 401k, you are basically telling the IRS that, IRS, now that I am keeping money for my retirement, I'm deferring the taxes to the future. So it's a deferred tax mechanism. When you put money in your retirement bucket, 401k, 403b, traditional IRA, and things like any pension, different pension plan, or solo 401k, whatever you want to call it, all those things are going to, when you put money there, you're getting a tax deferral. Tax is deferred to the future. So now, what we help people do is that most people leave money in this retirement buckets. And when they get older, when they get older, they get to 59 and a half, they want to get that money, then that's when they start paying taxes on that money. But this is when they're not making a lot of money. So they're trying to tax free. So what you want to do now is to try to convert all your traditional 401k or IRAs into Roth so that they are going tax free instead of going tax deferred. They are the basis, and the growth are all tax free because you already pay taxes on the basis. But if you don't pay taxes on the basis today, it's going to be deducting your taxable income, but it's going to defer it in the future. And then when you go on retirement, when you hit that 59 and a half, then you start paying taxes on that money. And many times it's not funny because all the growth now is going to be taxable. Now, to save money on your 401k, it's easy. So we just talked about saving money on other retirements. It's just how you basically structure whether you want to do this. There is something that is called, when you have money in the 401k is a good thing to do. And when you start building money in the 401k, the big thing is, how do I multiply growth on my 401k? You have already kept this money. This money is there. It's growing at it is growing at a rate that is not very crazy. It's not a crazy rate. Maybe it's growing at 2-3%, something like that. It's a great rate. But the key thing is, how can I accelerate that growth on my money? There's some well-kept secret out there that the wealthy are using, and it's not being propagandized to all of us out here, is that you can self-direct your 401k. You can self-direct your money. When you put money in 401k, it basically serves three purposes in Wall Street. It can invest in stocks, mutual funds, and ETFs. Those are the three buckets that you are basically investing your money in. So you can self-direct. Remember this. Let me give you an example. When you take an example like some of these very large corporations that are out there, TD Ameritrade, you call these people who are all these large companies investing your 401ks in. These companies, look at the executives of this company and ask yourself, how much do they earn per year? They make 70 million, 60 million. Some make $90 million a year. You are struggling barely to get 4%, 3% growth on your money. But the guy who is managing your money is making $70 million a year. Is that not something that should be questioned? What are they doing? Even though you are only allowed to invest in ETFs, stocks, and mutual funds, they are taking this money and investing them in high yield buckets. And they are taking most of this money. They are making a lot of money out of your money, the money of the middle class. They're taking the money, reinvesting in high yield buckets, and they are feeding being fat on top of your money. You too can do the same. You can basically divert that money. Self-directed is mainly rolling it from a normal 401k bucket, be it traditional or Roth, and then rolling it over to what you call a self-directed 401k, self-directed IRA. Once you self-direct your money, now you can invest in other things. You can invest in oil and gas funds. You can invest in gold. You can invest in real estate. Let me take an example for real estate. When you take that money now, let's say you had $100,000 sitting in there, it's growing at 2%, 3%, and things like that. Or at times it's even losing money because the market is based on the market. Now, if you took that same money and said, okay, I want to self-direct it. Now you say you want to buy real estate with it. Remember, you don't have access to the money until when you get to retirement, until you get 59 and a half. So you take that 100K, you put it down as a 10% down payment. You put it down as a down payment on a $1 million property, 10%. So you just multiply that money by 10. And then that real estate, because it's a rental property, it's the tenant who is going to be paying that property for you, how it's growing. But now, instead of you growing your estate on 10,000, on 100K, that 10% growth or 5% or whatever percentage growth, which was growing on 100,000, it's now growing on $1 million. And that growth is all yours. Even though 90% of that funding was other people's money, it is yours. So the growth, you own it 100%. So let's say it was a 5% growth and it was growing on 100,000, 5% growth rate annually. That 5% growth rate annually means that you're making how much? On a 100,000, you're making $5,000 every year as growth. But now, take that 5% and place it on $1 million. You're making $50,000. You just multiply the code by 10. And then that $1 million, someone is paying it down for you. So that is the game. You want to self-direct your things because you can invest them into live yield investments as well. So that is important. That is what it's all about. Another question, I don't see any further question. But this is something I wanted to answer. I wanted to answer all these questions because they've been flowing through. And I tell you, if you're out there and you have questions, just send them on our website, send them on our pages. We are going to gather them. And on every session like this, every week or every 2 times a week, I'm going to come on just to answer your questions. Thank you. I hope this has been helpful to someone. I hope these answers are the things you're looking for. And remember, when you send those questions within 2 days, we're going to get sessions like this on a podcast where we answer just those questions for you. Thank you very much. You have an excellent rest of your day. Bye-bye.